You're listening to Closing Market Weekly, the show where real estate closings meet real world insight. With your host, Phillip Hogan. And every week we break down the trends, tools, and the timing that keeps deals moving forward. Let's dive in. Hi, I'm Phillip Hogan, host of Closing Market Weekly. Welcome to another fantastic show. Many of you may know me as the CEO of Signing Services of America. In that role, I've worked with hundreds of professionals across the mortgage industry. And one of the things that I've learned in the time that I've worked with those professionals is that we are so busy caught up in our transactions that we are talking to one another, but not with one another. So therefore, I created Closing Market Weekly. So it's a forum for us to have a conversation with various professionals throughout the mortgage industry. And today's guest is someone who I think is going to bring a very interesting element to the mortgage space. And before we introduce him, let me go ahead and tell you a little bit more about our guest. Mo Phanor is an experienced mortgage professional with a strong background in mortgage loan professional management. He is also a Georgia licensed mortgage originator. Mo has a track record of successfully facilitating bulk mortgage servicing rights and whole loan transfers for Fannie Mae, Freddie Mac, Ginnie Mae, and co-issue private investor transactions. He is a results-driven mortgage professional with a proven expertise in loan portfolio management. Mo, welcome to the show.
Thanks for having me. I'm happy to be here.
Yeah. Oh my goodness. And so am I. And Mo, as we were talking before the show began, I'm really excited about our segment because you're going to be speaking on a level of information and expertise that many in the mortgage industry really don't know much about. And one of the things that I want to do with my show is create an educational format so we can inform those listeners about the various professionals that work within the mortgage industry and also what they do. So before we get into more about what you do, Mo, would you let us know a little bit more about why you became a mortgage loan originator?
Well, so I got into the mortgage industry right after the Great Recession, and at the time I had just finished a master's program. And when I entered the industry, I got into the portfolio management side of the business. The focus was trying to mitigate loss for mortgage banks and other banks, where there were a lot of modifications. Loans were being modified in order to help families stay in their homes. There were a lot of short sales. So from the jump, it was trying to kind of ensure that mortgage banks were doing the best that they can to mitigate loss. And also the government was interested in helping homeowners stay in their home and to try to stabilize pricing. I got into the industry by accident, meaning that after finishing the program, I was looking for a job, and I just happened to get a call from a recruiter, uh, initially asking me to get into the industry on um, the technology side, but I ended up in
Mhm.
portfolio management, and
Mhm.
it's been a wonderful accident. I'm glad that I got into the industry, and
So it's one. You said it's been a wonderful accident, right?
a
Isn't that
wonderful
really
accident.
interesting?
I
Isn't it
don't regret.
interesting? You say you don't regret?
I don't regret it at all.
Yeah, and apparently not, And so another guest on another episode, had a accident as well, and they got into real estate investing, and as a result, they have blossomed. So I don't know what's going on. Maybe we're just attracting those professionals that have accidentally gotten into the mortgage industry and have done a great job. But we're certainly glad to have you. So now, so would you please explain to us in the least technical terms as possible? What is a mortgage loan servicer? What is it and what do you do and how does it work?
So to start from the beginning, I
Yeah.
would say that you have what's called the primary market. So borrowers and loan officers, they start the process, and that's the
Mhm.
primary market. Primary market. The loan officer is uh, talking with the borrower and
Mhm.
working on the transaction. Once the
Mhm.
loan closes,
Mhm.
what happens is there is an asset that's created. The closed loan is an asset,
Mhm.
and there's a secondary asset, which is the rights to service that loan. So you
Mhm.
have the the loan, the mortgage loan itself, the rights or ownership of the principal and interest payments. And then the
Mhm.
secondary asset that's created when the loan closes
Mhm.
is the rights to service that loan. And
Mhm.
it's an asset because it generates income. So the
Mhm.
same way that the loan generates income, the servicing rights generate income. What the servicer.
So let me hold on a second. So let me just pull it out a little bit. So every loan that closes, every mortgage loan that closes has a services right component to it. Is that
So
correct?
well, there's some folks that will define it that way, but
Okay.
essentially, when the loan closes, so
Yes.
it's a whole loan. It closes it,
Mhm.
you sell it to an investor. The
Mhm.
investor is paying you a premium for for the loan itself, for that asset. And
Okay.
there is the secondary asset is the rights, which is some people there are some professionals who say, well, that right doesn't exist until that loan is sold. And
Right.
there are those who say, well, the right exists, it's dormant, it's there, but it's dormant. So when you sell that loan to an investor, let's say you sell that loan to Ginnie Mae or Freddie Mac. Ginnie Mae or Freddie Mac, they don't service the loan, which means they don't interact with the borrower. They're interested in the principal and interest payments, and
Mhm.
the managing the loan itself, talking to the borrower, collecting payments. All of that is done by the servicer.
Services.
So the
Right. So
servicer.
hold on. So hold on a second. Let's pull it back a little bit. Let's pull the curtain back
Sure.
a little bit more so folks can follow you. And because this is some very technical topics here. And many homeowners, don't really understand the connectivity, yes, and what you're saying here. So I want
Okay.
to just pull out
I
some
want to make
things.
sure I
So
connect it for you.
yeah, so I'm the homeowner, and
Mhm.
come to the table, with my attorney and the realtor, and I found my home, and the loan has been approved, and now we're ready to close, and I'm signing all these documents, and so the lender who is loaning me the money to buy my home has already identified the service provider.
So the home the when and your closing documents, you'll
Mhm.
often find that there is a notice of transfer.
There we
The
go.
That notice of transfer will either identify or introduce you to the
Mhm.
servicer
Very good.
of the loan,
Right.
or it will introduce you to let's say that there is a sub-servicer. So the lender has a sub-servicer. The sub-servicer would be a third party um, that they outsource to service the loan. So
Mhm.
they'll either introduce you to that servicer, or if the loan is they're going to sell that loan and they've already identified the purchaser, they'll introduce you to the purchaser servicer, for
So
example.
when you say sell a loan, so does that mean that they literally service selling the loan to the service provider the secondary market?
So let me try to kind of go back a little bit.
Mhm.
So when the borrower comes in and says, I'm interested in a loan,
Mhm.
and you have, let's say, what they call the qualified loan, which would be, the loans that Fannie Mae, Freddie Mac, and
Mhm.
Ginnie Mae kind of purchase.
Right.
They're going to originate that loan and underwrite that loan based on the requirements of one of those particular investors, and those, depending on which which investor. So let's use Fannie Mae as an example. Fannie Mae has their own underwriting requirements.
Mm-hmm.
So they've already identified that that loan is going to go to be sold to Fannie Mae.
Mm-hmm.
And so when the loan closes, the lender, uh, let's say it's an independent mortgage bank, that
Mm-hmm.
lender is has to make a decision. They can
Mm-hmm.
either for sure they're going to sell that loan
Mm-hmm.
because they're not in the business of keeping loans. They're in the business of uh, making loans, selling them so that they have
Mm-hmm.
funds to make more loans. So they're definitely going to sell that loan to Fannie Mae, since we're using Fannie Mae as an example. But
Mm-hmm.
they have the option to keep that loan, keep the rights to service that loan, or they
Mm-hmm.
have the option to sell the loan to Fannie Mae
Mm-hmm.
and the rights to
Mm-hmm.
service that loan to a different company or a different servicer.
Okay, so we got two transactions going on here. One is the right to sell the loan, and then the second would be to bring in a service provider or mortgage service provider to actually service that loan.
Right. So
Okay,
the
great. Okay, good.
right.
Uh-huh.
So
Go ahead.
that same loan,
Uh-huh.
it's essentially two assets.
Right.
One is the mortgage itself, the
And
ownership
then the
of
service
the
provider.
loan, right? The
Yeah.
rights to collect the principal and interest payments. Then you have
Right.
the second asset, which is the rights to collect payments from the borrower. Um,
Right.
to you have a series of responsibilities if you are the servicer. But
Mm-hmm.
essentially, you have these two things going on when the loan closes,
Mm-hmm.
and depending on the business model of the lender, that
Mm-hmm.
loan will either they will either keep the right to service that loan or sell it just as they sold the loan.
Right. And see, audience, that's why I brought Mo on. I've invited Mo to the show because this is some really, as you can hear, some really technical information that he's talking about and some very, very technical procedures that most homeowners really don't know about and maybe are unconcerned. However, I think that when you are purchasing a home, you need to understand every aspect of your loan. And Mo is talking about aspects that may not necessarily be discussed above board. And because they aren't, that doesn't mean they're not important. It just means that maybe some people really don't understand it well enough to explain to you as the new homeowner what's going on. However, here at Closing Market Weekly, we invite professionals to come in that will hopefully give you a little bit of a understanding in terms of what's going on behind the scenes when it comes to purchasing a home and all that's going into the loan requirements. So when you go to the signing table, you have just a little bit more information about what's happening. And even you may say, well, listen, what Mo and Phillip are talking about is great. It's not enough that they've talked about, but I want to take what they've given me and then do my own research and increase my research so I can learn more. So Mo, thank you for that information. What I also like you to talk about is that we have different Fannie Mae, Freddie Mac, Ginnie Mae. Would you please talk about what's the difference between what is Fannie Mae? What do they do or offer? What is Freddie Mac and what's the difference between Freddie Mac and Fannie Mae and then Ginnie Mae? I mean, are these family members here? so,
you,
so
you
I'm just teasing.
you
Go
could
ahead.
call them an interesting family, I would say. Um,
At the least.
yes. So Fannie Mae and Freddie Mac, they're called you know the right now those two companies are in conservatorship, but we won't get into that. But
Right.
what when you go in as a borrower, you go into to put in an application for a mortgage.
Uh-huh.
You can either get a conventional loan
Mm-hmm.
or a government loan.
Mm-hmm.
So Fannie Mae and Freddie Mac would be the the, the mortgage companies that purchase conventional loans. The conventional loan would be a loan where, um, let's say you don't have 20%, or you can't put 20% down. You have mortgage insurance. That mortgage insurance is a private mortgage insurance that
Mm-hmm.
you would get. But most of
Mm-hmm.
the Fannie and Freddie Mac loans will be folks that have really upper tier credit,
Mm-hmm.
and and they can afford a conventional loan where they're able to put down 20%, or if not, then they can put down less than 20, but they would get private mortgage insurance. Now,
Mm-hmm.
Ginnie Mae is what you would call the purchaser of government um, loan products. That includes your FHA loans, your USDA and VA loans, and and those loans, since they're government backed, for example, FHA is you're coming in with, you'll have a lower credit score. They allow lower credit score, higher debt to income ratio,
Mm-hmm.
and there are other things that make it kind of easier for someone who may not have top tier credit, may not
Mm-hmm.
have top tier income, to
Mm-hmm.
still get into a home.
Mm-hmm.
VA loans cater to veterans, and you
Mm-hmm.
have USDA loans that for folks that want to reside in more rural areas.
Mm-hmm.
So Fannie Mae, well, as again, those are the conventional Fannie Mae and Freddie Mac conventional loans. Ginnie Mae, you have those three government products: FHA, VA, and USDA.
So
So
what is a conventional loan, Mo? Tell us what a conventional loan is.
the conventional loan, um, it's a conform. I'm trying not to be too technical and saying that it's conforming. So the um, the criteria is a little bit different, and it's not a government product, which means it's not backed by the government. So FHA loan, the
Backed
insurance,
by the
the
government.
mortgage insurance,
Mm-hmm.
you pay mortgage insurance, and that insurance is actually um, a government kind of backed product.
Right.
Yep. The conventional loans are um, it's more of a private. The underwriting right is a little bit more rigorous.
Great. So
The
hold on. So let's that's what I needed you to say is that the conventional loan is private, whereas Fannie Mae and Freddie Mac are government backed loan.
No, so Fannie Mae and Freddie Mac are the conventional loans. They're
Okay, I'm sorry.
they're the purchasers of conventional loan products that require usually higher credit scores, usually uh, higher down payments, usually more reserve, meaning that you have to have more funds in reserve
Okay.
than you would have in a government backed product.
Hey Mo, so listen, great conversation here in regarding the variety of loans and loan products. And would you please share with the audience what are the categories of loans that a homeowner may apply for?
So the most popular loans on the market will be conventional loans, which are not government backed, and government backed loans. To give you an idea of what government backed loans are, if you're a veteran, you can apply for a VA loan, which is a government backed loan. If you are uh, a person with lower credit score, you have um, less money in reserves. This is good for first time home buyers, less money in reserve and less money to put down. Another government product would be an FHA loan. And there's also the USDA loan for folks who live or want to purchase a property in an area that's not urban, more rural.
Hmm. Great. Okay, wonderful. And so we may have the veteran in the audience who has not become a homeowner yet, and you mentioned something about the VA loan. And so can you talk a little bit about what would be the process the veteran would have to go through to get a VA approved loan?
So the veteran would have to be, just to ensure, reach out to the VA and
Mhm,
get a a, a letter showing
mhm,
that they're eligible for a VA loan. And
mhm,
once they supply that to the lender, then they can go ahead
mhm,
and go through the process of applying for a VA loan and so forth.
mhm,
So there is a process, and I would encourage any veteran to take advantage of that, because the lending requirements, or at least the the, the requirements to be approved, are
mhm,
very beneficial, and also the terms of those loans are advantageous to
mhm,
veterans.
mhm. Great. And so for the veteran who wants to become a homeowner, they would have to first go to the VA and get some type of documentation supporting that they qualify for the VA loan. Once that's done, they would present that to their lender. And
Yeah.
okay, and so once they present it to the lender, then the lender would begin the process of submitting the application for that veteran to seek or get approved for the loan to purchase that home.
Right. So to simplify the process, you
Mm-hmm.
get, show that you're eligible for a VA loan. The
Mm-hmm.
the loan officer will work with you to go through underwriting, and
Mm-hmm.
the underwriter will communicate with the VA to ensure that all the necessary paperwork is done, all the back back office stuff is done to ensure that
Mm-hmm.
um, the loan is originated and based on those requirements.
Okay.
It's a process just like any other loan application process or loan originating process. But
Mm-hmm.
I would encourage those veterans to really take advantage of that product.
Yeah, and so now let's tie it all together, right? You're a Georgia licensed loan originator. You have experience in working with the on the service mortgager side, and you also have experience as working on the front end where you are acting as a loan originator and someone's coming to you to apply for a loan. So if we have the veteran who has gone to the VA, has found a home, got a realtor, and looked at a number of homes, and now they have finally selected one that they would like to live in. They have gone to the VA, gotten the documentation, and the VA has given them the evidence, if you will, that they qualify for a loan. And now they reached out to the loan originator to the realtor, and the realtor that gives it to the loan originator, and the process begins of applying for the loan, and they've gotten approved, right? Okay, so now they're going through the process of preparing all the documentation. They come to the closing, and as the loan servicer, right, you are the loan servicer. Where would your company come into that process, right, to then begin servicing the loan once it's closed?
So the loan is closed.
Mm-hmm.
The as the loan is closed and it's owned by the lender. Let's say the
Mm-hmm.
lender is an independent mortgage bank.
Mm-hmm.
So that
Mm-hmm.
lender has the option to the lender will the independent mortgage bank will sell that loan.
Mm-hmm.
They're not keeping that loan. They will sell it, and it's going to be sold to an entity called Ginnie Mae. Now,
Mm-hmm.
Ginnie Mae is going to purchase the asset, which is
Mm-hmm.
the loan itself, which means they
Mhm,
have the right to the principal and interest payments on that loan.
mhm, mhm,
There is
mhm,
there's also a secondary asset that's created, and that
mhm,
secondary asset is called the mortgage servicing rights, which
mhm,
is the right to service that loan. And the right to
Mhm.
service that loan means the right to collect and receive monthly payments from the borrower, the right to interact with the borrower, answer questions from the borrower, any documents
Mhm.
that need to be sent, like your mortgage statement will be sent by that servicer.
Mhm.
Your that servicer will pay your es- that servicer will pay your taxes if the loan is escrowed. I don't
Mhm.
know if you want me to explain what it means, what escrowed mean. So when
No, not at this time. Not at this time.
Okay. So that servicer will, if your loan is escrowed, so when you
Mhm.
make your monthly payment includes the principal and interest. It
Mhm.
also includes escrow, which is your taxes and insurance. The
Mhm.
servicer is collecting your taxes and insurance on a monthly basis. When it's
Mhm.
time to pay your insurance premium, the
Mhm.
servicer will pay your insurance premium. When it's time to
Mhm.
pay your property taxes, the servicer will pay the property taxes.
Mhm.
So that's the responsibility that the servicer has to the borrower. The servicer
Mhm.
also has the a responsibility to the owner of that loan, which is the,
Mhm.
as we said,
Mhm.
purchase that.
Mhm.
The responsibility that they have is to ensure that they're following all state and federal rules when it comes to servicing. They have
Mhm.
the responsibility of making sure that um, they're depositing the your payments into the investor account. So when
Mhm.
they collect the borrower's payment, the payment
Right.
belongs to the owner of the loan, the investor. Those
Mhm.
payments have to be deposited into the investor's account.
So Mo, so this is great. So you really has spelled out, right, the entire process of once the loan has been approved and how the service provider comes in and all that the roles that that organization does. Does the does the signer or the homeowner have any involvement in selecting who the service provider is?
No, not at all.
Okay, good. Not at all. So that's all done behind the scenes. It has no involvement. The signer has no involvement in that conversation or the decision making. They're just a participant because once the loan is actually sold to the service provider, then that's when the service provider begins communicating with the homeowner who they are and what to possibly expect in the relationship between the homeowner and the service provider.
So let me kind of outline um, an example of what happens.
Mm-hmm.
So the loan closes
Mm-hmm.
and it's sold to the investor,
Mm-hmm.
and you have uh, the servicer has to send the homeowner a welcome package.
There we go. Yes.
The welcome
I remember
package
I
is
remember I remember receiving one of those, right? When I purchased my first home. That's why I'm asking you to the show because I was completely, confused when I purchased when I made my first home purchase, which was an investment property, and I had no idea. I think it was Ogden, and they were the service providers. And well, who are these people? How did they find out about me? And what involvement do they have? So when I found out again, I said this in the opening of the show. I wanted you to come on because I think that you have not I think you have a very important role, but it's so well, it's so removed, if you will, from the beginning, the first days of the loan process that individuals don't know that you exist. And there's no promotion that this is what's going to happen, right? And going through those thick documents of papers that need to be signed, this many times people really not paying attention to the title of the document that they're signing, where yet one of those documents clearly explains to them that this loan is going to be sold to a service provider. So please continue.
so the loan is sold. It's sold to an investor,
Mm-hmm.
and the rights to service that loan is sold
Mm-hmm.
to a servicer. So you have
Right.
two entities. So you have an entity that owns the loan, and the entity that you're going to interact with more
Mm-hmm.
often is going to be the servicer. Now you know, there are banks that they keep their loans, they don't sell them, but most likely, most loans that are closed will be sold to an investor, and you're going to have an entity servicing that loan. And sometimes the investor, so you have the investor that is going to pay the servicer to service that loan
Mm-hmm.
in their behalf. And
Mm-hmm.
that servicer is going to be who you interact with. Throughout the life
Right.
of the loan, the rights to service that loan may be sold to multiple entities.
Right.
So
Right. Very good. Very good.
the responsibilities that they have, though, when the loan is sold to a different entity, they have 15 days to make the borrower aware of that change, that servicing change.
So let's back up here and let's pause and not back up, but really pull out what you just said. That
Okay,
over the life of that loan, it may be sold to different service providers, and the service
let's
provider, the
call them
new,
servicers. Servicers.
let's go what?
Let's call them servicers
Let's call them
instead
service.
of
Okay,
service
great.
providers.
So the servicer, so the loan could be sold to numerous servicers over the life of that loan. And within 15 days, that new servicer must communicate with the homeowner who they are and how they work and all the requirements. Am I correct?
Let me just state it this way: the you have the current servicer and the new servicer. The response.
Okay, Mo. So listen, thank you for that information. So the servicer will change, could change throughout the life of the loan. And you were saying that that servicer, when they're new to the loan, has 15 days to communicate who they are, what their procedures are to the homeowner. Okay, Mo. So great information again, we're talking about. So you're saying that in the life of the loan, it could change from different servicers. Share with us what is the process for a servicer to come on board and then the old servicer to turn over that information or that account to the new servicer.
So the way that it works is that
Mm-hmm.
the existing or current servicer has to introduce the new servicer to the borrower, and they have to do that within 15 days of the effective date of transfer.
Mm-hmm.
So prior to 15 days prior to the transfer date, they have to let the borrower know, hey, your loan is going to be transferred to servicer XYZ. This is
Mm-hmm.
the contact information. This is the
Mm-hmm.
last day that we're going to collect payments from you. And after
Mm-hmm.
this date, we'll be paying or sending your payments to the new servicer, to XYZ servicer.
Mm-hmm.
So they're introducing, the current servicer introduces the new servicer to the borrower.
Mm-hmm.
And the new servicer will send the borrower a welcome package. And the
Mm-hmm.
welcome package will kind of give the borrower information on where to send payments, how to create an online account through
Mm-hmm.
their payment portal, and how to
Mm-hmm.
a toll-free number to reach customer service, and some other
Mm-hmm.
information. So it
Mm-hmm.
has to work in coordination where first the current servicer or old servicer introduces the new servicer, and then the new
Mm-hmm.
servicer sends a welcome letter or welcome package to the borrower, giving them the necessary information to make payments and to reach out and customer service and so forth.
Fantastic. Fantastic. Well, Mo, listen, the time is coming for us to come to a close, unfortunately. But this has been a, a very informative conversation. I knew it would be. And, I couldn't have had a better person or more informed person, more experienced person to come to the show to talk about a really technical aspect of the mortgage loan process. And for our new homeowners or even existing homeowners who may not have known about the information that Mo's talked about, we are here to share with you and educate you through the process. So if a listener may have some additional questions or would like to contact you, Mo, how would you like them to reach out to you?
You can reach out to me by going to LinkedIn and searching for me on LinkedIn. You can spell out my full name, Moise, last name Phanor, Moise Phanor, or you can simply search Mo Phanor, just Mo, and then my last name, Phanor.
Great. Okay, folks. So there you have it. So if you like to reach out to Mo for any reason as it relates to the mortgage industry, loan origination, information, Mo is a person that we want you to reach out to, and I'm sure he'd be happy to talk with you and will be just as informative with you as he has been on our show. And for those listeners, thank you so much for following Closing Market Weekly. You can find our content on the YouTube channel, Closing Market Weekly, or Spotify and Apple. And if you do visit us on YouTube, please subscribe, follow, and share. And we look forward to you joining our community. Thank you for your time, and we'll see you on the next show. Bye for now. Thanks for tuning in to the Closing Market Weekly. If you found this episode valuable, don't forget to like, subscribe, and share it with someone in the industry. For more insights from the front lines of real estate closings, we'll see you next week.